Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, April 3rd, 2024 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another market open. Well, we had the ADP employment report out this morning, and it came in a little bit hotter than expected. Not a huge number, but we did see the market almost immediately come back down as far as futures. Futures were up this morning, and they have turned negative. Basically, the major indices are roughly about 1/3 of 1% to maybe about 0.4 of 1%, kind of in that range, lower this morning. And we'll see whether or not that continues into the open, but I wouldn't be surprised. I mean, clearly, we're in a little bit of a downtrend here so far to open April, to open the second quarter of the year. This isn't typically a bad quarter, and especially the first half of this quarter tends to be pretty good as we approach earnings season and move our way through earnings season. But so far, uncharacteristically, we have gotten off to a rough start. And so technically, we just have to watch and hopefully get that reversal and get the market going back up again. But again, we need to keep in mind how far we've run. And I think when we keep that perspective in mind, having a little bit of selling isn't really too big of a deal. I do want to say, though, that ADP report did come in at 184,000 jobs versus the 150,000 that was expected. The consensus range was literally 125 to 175, so we did come in above even the highest estimates. And the prior month was revised higher from 140 to 155,000. So overall, I mean, when you get a 10% revision higher in the prior month and then you come in above all of the estimates, that does tend to weigh a little bit, just because, again, it's almost like we're on a tightrope. We want to see strength in the economy, but we don't want to see too much strength. We see the inflation coming down, but the Fed still has to keep one eye on what could happen. They're not going, and they've made this pretty clear, they're not going to cut rates until they feel like they've won this war against inflation. That was a little different than what they said, a year and a half ago, what they were looking for. But again, that's kind of changed as we've evolved through the last couple of years. But right now, I think still things are on track. Personally, for me, I think that the news here on the jobs has been great. I think a lot of us, with rates going up, a lot of folks in the market were fearing maybe that the economy would take a big hit because of rates going up. Not only just going up, but going up so fast. You may easily forget, but we went from near zero rates to over 5% in the Fed funds rate in a year, a little over a year. So, that kind of a jolt to the economy wouldn't be totally unexpected. And yet the economy has remained very resilient, which to me is a great sign. Anytime you can see inflation coming down and then the economy strong, that combination usually will result in higher prices. I think the market's anticipated that, which is why we've seen such a big run up so far in 2024. And of course, started throughout 2023, especially on the large cap Nasdaq names. Anyway, let's go ahead and take a look at what happened on Tuesday and get at least a little bit of a feel for maybe where we might be heading today. Dow Jones Industrial Average yesterday down a full percentage point, almost 400 points. So that 40,000 level, just going to have to wait a little bit here. Back down to 39,170. So now we're a full couple percentage points away. S&P 500 lost 38 points. That was about almost 0.75%. Nasdaq 100 dropping 171 points. That was 0.94%. So getting close to 1%. Small caps and mid caps again taking it on the chin the hardest. Mid caps dropping 1.3%. And Russell 2000 more than 1.8%. So both of those indices down. And it is noteworthy, Nasdaq 100 yesterday, even though it did rally late in the afternoon and tried to reclaim its 20-day moving average, did actually close below its 20-day moving average by 9 points yesterday. So just pointing it out because we haven't seen many closes below that rising 20-day moving average over the last several months. but we did do it yesterday. IWM clearly down below its 20-day moving average. I wrote about this in our daily market report to members yesterday. There were a number of different levels that we wanted to watch, one of which we'd already lost, which was the breakout level at 208.21. That went yesterday, or the day before yesterday, on the after the shooting star candle. Actually, the day before yesterday, actually went down just above it. So we were watching 208.21. I think we closed like 208.30 or somewhere in that neighborhood. And then yesterday, we gapped down well below that 208.21 level and closed below the 20-day moving average. We'd actually opened above it. So I was hoping, and we did get a little rally in the afternoon, but it wasn't enough. But what I was hoping for was a big rally to finish back on the IWM above the 205 level, and it put in a hammer off this recent downtrend, the hammer being just above, closing back just above that 20-day moving average. Didn't happen. We got the close below the 20-day. And for me, it now opens up the possibility of a test of the up channel that it's been in for the last few months. And I'll show you that in just a minute. Transports down 184 points. That was down 1.15%. All that uptrend talk I was talking about and how we might get that breakout didn't happen, which is why we always watch and say you got to see the breakout. When you trade and you anticipate a breakout, you know, it looks good and you see that prior resistance, but you believe it's going to go through. So you want to get in a little early before everybody else. Well, that has its risks as well. And we saw that with transportation yesterday. Looked like it was on the verge of a breakout last couple of days. Says, nope, not yet. Came back down, I think closed below the 20-day, but above the 50, if I'm not mistaken. Yes. So you had the 20-day about 50 or 60 points. Is that right? No, about 36 points. 20-day was about 36 points above the 50-day. The transports came down and closed in the middle, right between the two of them. So not really telling us that we're rolling over, but also not exactly bouncing like we would expect if this truly was an uptrend. And with futures down, I suspect we're going to be down below both these moving averages. So transports be interesting to watch today, because if we don't get a bounce back today, transports could be on its way back down to that 15.4 level again, and possibly even the 15.2 level that I've talked about being the biggest support area. So we want to keep an eye on transports. Energy continues its move to the upside. Once again, if you're in energy, congratulations. I personally would just keep raising my stop, stick with it, but it's been an absolutely tremendous performer here over the last month and a half. Healthcare took a hit yesterday. It was the biggest group to fall. The Medicaid Advantage rates did not come in as high as expected. And as a result, the healthcare providers group down across the board. And I'll show you that chart in just a minute. But that led to some weakness in healthcare. Discretionary losing 1.47%. We had really rough clothing and accessories group, and also autos. Tesla did not react well. They came out with their deliveries for the first quarter, and they were down 8% from the prior year, and the market just didn't like it. And I'll tell you what, you know, I'll be honest here. I've said probably for the last couple of years, few years maybe, that Tesla, if I had to hold one stock in the market, it probably would be Tesla. Fortunately, as a trader, I don't have to hold a stock for a long time, and I like to hold stocks that are trending higher for the most part. So I've been out of Tesla, but you've got to wonder about someone like Cathie Wood, who manages those ARK funds, who when she gets a stock that she likes and the stock keeps going down, she just keeps buying it, which maybe down the road will turn out to be great. But I can tell you it's killing her funds over the past couple of years. There's something to be said for being in stocks and accumulating stocks that are leaders, not laggards. And Tesla continues to drop. And I keep seeing headlines where she's adding more and more stocks that, you know, are in her top 5. Hasn't proven to be a very good strategy. And, you know, continuing to pour money into a stock that is severely underperforming is a recipe for short-term disaster. I think you're seeing some of that in some of those funds. But just wanted to point out, because Tesla has not been a very good performer, and it's certainly holding down the discretionary area of the market where we have not seen a breakout. I mean, discretionary, we're almost where we were back in middle part of December. maybe actually slightly below. You look at just about any other area of the market, especially the leading areas of the market, that is not the case. I mean, the NDX middle of December was down below 17,000, probably around 16.8. And even with the weakness we've seen over the last couple of weeks in the Nasdaq 100, we're still sitting at 18.1. So it's just been a rough go for discretionary stocks. But keep in mind, when you look at something like the XLY, it's not a widely diversified ETF tracking all these different areas within discretionary. It is a very concentrated ETF, and its two largest holdings account for about 50% of that XLY. And those two holdings are Amazon, which has been doing fine, and Tesla, which has been underperforming really badly. So I think you got to be careful with the XLY until you get a healthier Tesla. We'll see what happens. Anyway, moving on to those three charts I just talked about. Here's the healthcare providers. You can see a big hit, lost the low, that support from earlier in August. All right, we're in March or we're in April. So March is the month I'm looking at here. Anyway, we broke below that early March low and now on our way possibly to threaten the low that we saw back in February. So this group definitely found a lot of issues with that Medicaid Advantage number that came out. And it was across the board. It really wasn't just one or two healthcare providers. Many of the healthcare providers took big hits. Clothing and accessories, another one, really since the Lululemon report came out, this group has been going down. Of course, Lululemon continues to go down. It's a big factor in this index. Not really showing any signs, though. I mean, that is a bear flag, broke down again yesterday. Really, really poor looking chart on clothing and accessories right now. And then there's the autos. So, and pretty much as the autos go, Tesla goes, or as Tesla goes, the autos go. And so you can see since the beginning of the year, it has been a very, very rough ride, no pun intended, on Tesla and on the auto group in general. All right, 10-year Treasury yield. So what kind of reaction are we getting in the bond market with the higher than expected ADP employment report? Well, as you might expect, we got rates going up again. And honestly, I think that is spooking U.S. equities. I think it will continue to spook U.S. equities as long as we stay in this uptrend. So, I said when we broke this cup, talked about it yesterday, this breakout, this measures up to about 466 on the 10-year Treasury yield. We're at 441. If we go up another 25 basis points and hit that target, I would find it hard to imagine that equities are at the same price or at the same level or higher. Maybe I'm going to be wrong, but this was when I talked about a possible catalyst back in mid-March, even earlier than that, when the market, I thought we might have some choppiness or maybe even some downside action. I thought the catalyst would be possibly higher interest rates if we broke above that 435 level. And that's what we've done. And you can see the reaction in equity. So I think as long as the yield keeps going up, we're going to struggle in the stock market. I don't think this is a long-term uptrend. Although if we pull up a 5-year weekly chart, I mean, you can see since the middle of 2020, rates have been going up. I mean, this has been a series of higher highs and higher lows. So I can talk about rates, being steady or coming back down maybe in 2024 later this year, all I want. But right now, the chart is saying it's going higher. We haven't broken out above 5. I think 5 was a pretty key level. I think the market further out can sustain an advance to the upside, albeit maybe a little bit slower advance if rates were to break slightly above 5%. But that is going to be a headwind for equities if rates continue to move higher, and especially if they move appreciably higher. If they go a little above 5%, I'm going to be nervous. If they go up to 6%, I think that's bad news for stocks. You always have to have your lines in the sand. Just historically, moving up and getting back to about that 6% level, if you go back into the 1960s, once you kind of got that level, that bull market, for the most part, had run its course. So I'm just throwing it out there. I don't expect to see rates that high. I'm just saying if it does, know the history. So it's something to keep an eye on. So if we go up to 450, 460, 470, even double test that 5 level, I think that would pose some problems for equities. I don't think it would take equities down. I think when I say take them down, I mean take them down. I think we would see some weakness, but I don't think we would see huge selling. But let's just keep an eye on that one. That's probably, if ask me what keeps me up at night about my bull market call, it's interest rates and where they go, the 10-year Treasury yield. That's probably my biggest concern in the short to intermediate term. S&P 500 moving up continually. Yesterday down. Notice most of that move to the downside was a gap. I want to keep pointing that out because when you move down and it's all at the gap open, it's not really a lot of room for distribution. Not a lot of room for institutions to get out. You don't put in your million share request to sell a stock at 9:30 a.m. Eastern. You don't do it. I mean, you might tell the market maker, whoever your market maker is that's doing, they're going to orchestrate the sale, may tell them in advance, but the market maker is not going to be selling if they're trying to get the best share or best price possible for their institutional clients. They're not going to try and sell shares during the most illiquid part of the trading day, which is at the opening bell. It's not going to happen. That's not the way. I mean, I've never worked for these institutions. I've never worked for a market maker, but I have a brain. I have common sense. It ain't happening at the opening bell. That's not when the big selling takes place. Selling takes place throughout the day. And especially if the market's going to go lower, we should be seeing a lot of selling in the afternoon. And still really not a whole lot of evidence of that. So I'm still feeling fine about the market. Short term, yeah. I mean, I said back in March, I thought we had some issues. I thought getting through March without any serious selling was certainly a bonus. But we're seeing some of those problems surface in early April, and we have to deal with them. But I do think longer term, I think we could get a 50-day test. I would not be surprised to see a 50-day test at some point, just because that's what happens in the stock market. You don't just trade up above the 20-day forever. 2017 was one of those years that tried to, but for the most part, that's not really what we should be expecting. Nasdaq 100, still with the negative divergences on the highs, coming back down. You can see now the PPO though is at 0.65. It was as high as maybe a little over 2 back in December. So we've seen a lot of that bullishness reined in just by the fact that the move to the upside, the strength of the move to the upside, the momentum of the move to the upside has slowed over the last 2 months. I mean, if you look at this move off of the bottom at the end of October, the slope of that advance was much stronger than the slope of the advance we've seen over the last 60 days or so. So definitely the market's going through a different phase, but it's kind of worked its way through some times when the market tends to struggle and really didn't have a whole lot of selling. So I do find that still to be somewhat of a positive. But as far as the beginning of April, we'll see. Maybe we get down, get that 50-day test. Maybe we finally get a zero line test on the PPO on the NASDAQ. That would actually, I always like to see resets. So we'll see what happens with that. All right, IWM. So what I mentioned at the top of the show, I wanted to show you this channel because this is the third area of support that I've told members to keep an eye on. So if you take the highs and you connect these highs right here, essentially, if we take that line and we drag it down and connect the first low that we saw back here, notice that the same slope that connects the highs also connects the lows. That's a beautiful channel. And it's not a good thing when you break channels, at least not in the short term. So, and we were going up in this channel over 3 months. We went from a low of 187 to a high of 212. That's 25 points, which is what, 13%? 13% over 3 months from low to high. That's kind of a steep slope. I don't know that this slope will continue. Maybe it will. It probably will pick up if we ever take out the all-time high. But that we still got a ways to go on that. But for right now, we broke out above that 208.21 level. So that's what I wanted to hold. Here was the breakout. This was last Thursday. Friday, we put in the shooting star. For those of you that were at my candlestick event back on Monday, There's the shooting star, which is a reversal, the reversing candle. We went down after that. And yesterday, gap down. Most of the selling yesterday was the gap down. We actually came back up late in the day, and you can see that candle body wasn't that great. And even the AD line took a little bit of a hit, but not much, because we went back and closed in the middle of the range. So if you close exactly in the middle of the range, there's no change in your AD line. Close at the top of the range, you take all the volume and you add it to the AD line. You finish at the bottom like we did on Monday, or pretty close to that bottom, and you take all the volume and you subtract it. So when you have big volume days, it really impacts the AD line depending on where you close, because the volume is the multiplier. So if you have a day where you close on the high of the day, you add the volume. Well, if it's a light volume day, the AD line is not going to go up much. But if it's a big volume day, you'll see a big jump in the AD line. Anyhow, so 20-day moving average was the second level I wanted to watch, and we did not close back above it. We were trying, fell short, closed below the 20, and just like we did, I don't know, maybe 2-3 weeks ago. And so I think short term, we could have a test of this 202 level, which is where the lower channel line exists right now. And channels are kind of subject to, how you draw them. They're somewhat subjective. Like, I don't know, I could have taken the intraday highs, which would have meant the slope would have been like that. And then I would have had to have gotten rid of this and then tried to see where I would connect the intraday low. So I'm going to take it from this low point right here. And this would maybe suggest maybe 201.5. So again, it doesn't give us an exact number like a price. That number I knew was 208.21 because that was the open. So it's the high candle body that I was watching. If you look at intraday highs, you can go back and see what that intraday high was. But you can literally get it down to the penny. Channel lines, trend lines are a little more subjective. You don't really know exactly. But if you see a big red candle come down way below this line, it's not going to matter how you draw that line. It's a clear breakdown, and that's what we want to watch for. If that were to occur, let me get out of this. I think if you lose the channel line, then you're looking at the IWM on a weekly chart. And for me, that would be that rising 20-week moving average, which right now is at 197.36. So if you drop much below about the 201.5, 202 level, and looks like we're breaking down on that channel, just remember the long-term chart, the really big level to watch on a closing basis. And this is a weekly chart, so it would be a Friday close. So if, over the next, between today and tomorrow, let's say, things really get ugly, we lose another $4 today. And then maybe Thursday, it goes down another $2 or $3. Next thing you know, we're down at 195, 196. We recover on Friday, go back up to 199 or 198. You'll see that we'll have a tail below the moving average, and we'll come back up and we'll have a close above it. So when you're looking at candlesticks on a weekly chart, remember the open's Monday morning, the close is Friday afternoon. You don't have 5 candle bodies. You have 1 candle body for the entire week. So that doesn't print until Friday's close. So just keep that in mind, because I've had members or, I've had other listeners that have written in and have said, what about this candle today? And it's middle of the day. I'm thinking, well, it hasn't formed yet. I mean, we know what it's doing halfway through the day. We don't know what it's doing at the close. With a weekly candle, you actually have to wait till the end of the week. So if something's happening on the weekly candle on a Monday or a Tuesday, you have 3 more days before that actual candle prints. Makes it a little bit tougher to make calls on a weekly chart because you're not hours away from a close, you're days away sometimes. Anyhow, moving on. Transports, this was the close between the 20 and the 50. Again, failure up at around 16.2. Support right here at 15.4. Then the biggie at 15.2 in my view. So you got a couple levels to watch pretty close together to the downside. You've got these moving averages, and the reason the moving averages are important is because if you're trending, you should hold them on the way down. We failed to hold the 20 yesterday. Probably going to gap below the 50 unless we get a reversing candle today. Looks like we're just still in this sideways consolidation for transports. Kind of disappointing for me anyway, because I thought we were going to get that breakout. I thought we were going to continue to roll with the IWM. These two tend to go together, and right now they're both going down together. We'll see what happens today. All right. If you head over to earningsbeats.com, you can sign up for our free 30-day no-cost trial. Also, we do have this 4-part series that's going to be continuing throughout April. We talked about candlesticks on Monday at 4:30 p.m. Eastern. We now have a recording that is available for any of our members. Check that out. Price volume is going to be next Monday. So I'm going to talk a lot about price support and how I use it and how I manage my risk, which is really important. So that topic will be Monday at 4:30. If you want to be a part of this series, register. You're guaranteed to be in all 4 as a free trial member. Remember, the trial membership goes 30 days. These courses will all be done by April 22nd, which is 3 weeks away. So we're talking about 30-day free trial covering all of these courses. So a great time to at least give our service a trial. And also, if you just want to check out some of the things we do, sign up for our EB Digest. It's a free newsletter, no credit card required. You can unsubscribe at any time. Also takes a name and an email address. Hit the subscribe button and you're set up. So today, I'm going to point out the internet stocks, just because internet tends to like this upcoming period where we are right now. If you look at April, starting in April, all the way through July, look at the percentage month that the internet stocks go up. In April, they go up 2/3, and I've gone back since the beginning of this bull market, so since 2013. But since 2013, 2/3 of all Aprils have been higher. 3/4 of Mays and Junes have been higher. 9/10, basically, it's only missed 1 year in the month of July. That's when internet stocks have made a pretty big move. If you add these 3 or 4 months up, April through July, during this bull market, take 2.7 and 3.4, that's 6.1, plus 0.3 is 6.4, add another 6.4, 12.8. The internet group has averaged going up 12.8% from the beginning of April through the end of July over the last 12 years. Let me say that again. Internet stocks have averaged going up 12.8%, almost 13% in 4 months. If they did that all year, you'd take those 4 months, you have to multiply it by 3, right? 3 times 12.8 would be 38.4. 38.4 is the annualized rate of return on internet stocks over the course of the next 4 months. That's good performance, really good performance. You can see 6.4%, by far the best month. And if you're looking for other months, this is the first month of the quarter. This is earnings season. It's when earnings season gets going. It's the run up into earnings season. January is the second best month. What is that? Run up into earnings season. The fourth best month is April. What's that? The first month of the quarter. So when you look at the first months of the quarter, October's 2%. Add those up. 4.5, 2.7, that's 7.2. 6.4, that's 13.6. Add another 2%, 15.6. It's even better when you look at it as April being part of this first month club, first month of every quarter. So this is what I wanted to talk about in the EB Digest today. Unfortunately, I haven't gotten it out. And if you've looked in your email and you haven't seen it, and you're wondering why, now you know who to blame. It's me. Nobody else at Earnings Beats. It's me. I haven't gotten the article out yet. But this is what I'm going to talk about because it is early in April. You need to know that this is a sweet spot for the internet group. Number one, because it is the first month of a calendar quarter, which you've seen very strong across the board. All 4 quarters tend to see this move to the upside in the internet. And then if you just look at the next 4 months, this is the strongest 4-month period of the year. for internet stocks. Google just broke out. Google is part of this group. I think, well, I mean, we could probably take a look what time we got. That's 9:30. Let me give you a couple. Actually, best way to go is just go into the dashboard and go into scooter reports right here. Large cap, type in internet. Here are the highest scooter ranked large cap internet stocks: DoorDash, Spotify, GoDaddy, Meta, Netflix, and then Google. But Google just made the breakout. So you could see this scooter score starting to rise pretty quickly, assuming that it continues its advance to the upside and outperforms, because it has been showing some leadership of late. But right now, undisputed leader is Dash. Pull up Dash. What's the chart look like? Been going up, but it does have a negative divergence. So I'm fine with being in DoorDash, but if it loses the 20-day, be careful, because we could see the 50-day come into play. That would be one. How about, mid caps have been so hot of late. How about a mid cap internet stock? Well, hit mid caps and you still got internet. Here are your top mid cap stocks. TripAdvisor 95.5. Big move up. That was earnings related. Sideways consolidation. Nice little hammerish kind of looking candle right at the 20-day. Wouldn't be surprised to see a big pop again coming in TripAdvisor. And then individual stocks, you could go back to the seasonality and just pull them up. Trip. We'll look at this one in Dash and we'll wrap up. April doesn't look like a great month for TripAdvisor. Last 12 months, only going up 1/3 of the time, and its average losing in April. One thing that might be interesting, though, is let me look and see when Trip reports its earnings. May. So it's not an April earnings. So maybe the second month of each quarter, maybe that's when that stock does better. Let's take a look. February averages 8.2%, May 1.8, August down 1, November down 1. That's not really good either. It may just be that this isn't a great long-term chart, because I'm not really seeing great seasonality anywhere. Let's pull in Trip up. Let's go monthly 15. Oh, yeah. Well, you're not going to have a whole lot of great seasonality when the stock is down 60, 70% or more over the last 10 years. So that helps to explain the seasonality. Dash has not been a public company for very long, so it's only got 3 or 4 years. Really a tough one to talk about there. Let's go back. Let's take a look at ENV long-term chart. Yeah, sideways, but back up above the 20-week. Instead, let's go back and look at that is large cap. Okay, but internet. All right, so large cap, we got Spot, which just passed Dash, probably because we just opened and whatever they're doing today. Looks like Spotify is up on its scooter score. Big gap up on Spotify today. Maybe Spotify has a better seasonality track record. Well, it only has 7 years, I think. And April's okay, but May and June are very strong. Again, only going back 7 years, though. But Spotify, at least over the 7 years, 50% of Mays are higher with an average 4.6 return. 83, so that's going to be 5/6, because we haven't had June in 2024 yet. So it's really only 6 Junes. 5 of them have been higher, and they've averaged going up 11.8%. I tend to ignore seasonality when it doesn't have a long track record. But if you like the stock based on other factors, maybe this helps to contribute to you feeling more bullish about it. I don't know. Anyway, Spotify looks pretty good, but I know Meta likes April. Google, of course, likes April. And so, I don't know, check those out. But internet stocks, we are in a sweet spot. Maybe if the market sells off, we'll get some opportunities to get in some internet stocks a little bit cheaper. So that's a potential positive down the road. Let's take a quick look and see what the market is doing. Dow flat, S&P flat, Nasdaq down about 1/3 of 1%. Small caps about the same. Mid caps only down a little bit more than 1/10 of 1%. VIX now up above 15. So we were up to 15 and change yesterday, came back down to 1460. Now we're back up over that 15 level. Kind of watch 17 to 20. I think up to 17 is fine. I think when you get above, if you get above 20, that's where we got to really be careful, because that's when the damage is done on equities. But as long as we're below 20, we're okay, especially if we're below 17. But in the near term, obviously we could see that VIX fluctuate. All right, that's it for me. We do have a live trading room coming up in 25 minutes, 10 o'clock every Wednesday. So if you do sign up for a 30-day trial, come on in and join us in the live trading room in 25 minutes. I'm sure I'll find a stock or two that I can take a short-term trade on, and I'd love to have you on board with us. Have a great day, everybody. Happy trading.